So today we're talking about, this is the introductory of technical analysis. So what is technical analysis? It's a type of financial analysis that uses patterns in market data to identify trends and make predictions. So behind here you can kind of see some simple moving averages over a chart. That's actually going to be one of the first things that we talk about, is a simple moving average. Before we get into that though, let's discuss the pros and cons of technical analysis. So every analysis that we're going to cover is going to have pros and cons. And it's really important that you understand what the analysis is good for and what its weaknesses are. That way that you're informed and that you can try to build a trading strategy around it. Personally, I use multiple different analysis in my trading plans. So what technical analysis is good for is it's visual. This is great for beginner traders because instead of looking at accounting numbers or doing something like that, you can just look at a chart and it's very simplified. There's no, you don't have to do any calculations or know any specific data. The entry and exit points are amazing in the technical analysis. They can give you down to a T when to buy into a stock and when to sell a stock. Also, it can give insight into trader sentiment because ultimately price is comprised of buyers and sellers, supply and demand. And that's reflected in the stock prices. So if you have a greater demand than you do have supply, that's what causes a stock to rise. This sounds very simplified, but a lot of people skip these steps, that these are actually economic markets and the price is made up of supply and demand. And then it's also useful for short-term trading. So if you're trying to split trades weekly or something like that, fundamental analysis isn't going to do any good for you because it focuses on a longer time period, right? You're looking at periods of 3 months or 6 months or a year or 2 years out, right? So technical analysis is great for any short-term traders. And I'm going to make I'm going to differentiate trading and investing again. I talked a little bit about it at the beginning. Trading is whenever you're in and out of trades, you're switching your positions pretty often, and investing is whenever you're holding something for a long term. So Warren Buffett is an investor, he's not a trader. High frequency people are traders, high frequency trading, right? So now that we've covered the pros, let's get to the cons. It's based off of historical prices. So whenever you're looking at these charts, it's not going to tell you about the tariffs, right? If you're looking at these steel charts, it's not going to be like, hey, there's a tariff that might affect price. It's just going to tell you what price was in the past, so it doesn't involve any current news. It also doesn't look at the fundamental or intrinsic value. So this is massive because if you remember the dot-com bubble, right? All those companies were heavily overvalued intrinsically. Like if you looked at their balance sheet, they were just out of proportion. No fundamental investor would have touched them. But you can get a technical buy-in on a company that's overvalued. So this happens all the time. This is one of the weakest points. I just really want to highlight this, is that you can get a buy-in on a bad company and not know that's a bad company because you're not looking at its intrinsic value. It also tends to underperform in volatile environments. So if the stock market is doing crazy dips and things like that, technical analysis, especially simple moving averages, can kind of give you false breakouts or false buy-ins, which is the last point.